Welcome back to Investing Talk Podcast. Today, we're tackling a company that, well, it recently went on a truly astonishing run, Ramaco Resources. For anyone currently thinking, is Ramaco Resources a good time to buy now? Hi, you've definitely come to the right place. We're going to try and synthesize the facts, give you the full context.
Yeah, our mission today is really to cut through some of the noise here. Ramaco is sitting right at this interesting intersection. You've got old economy stability, which is metallurgical coal, and then this explosive sort of future economy speculation around rare earth elements. So we've synthesized their fundamental financial health, we've analyzed that recent almost wild price surge, and looked closely at the long-term catalyst to give you, hopefully, a clear, consolidated view.
Absolutely. And before we get into this really fascinating story, please remember to hit that subscribe button, like this video, and definitely leave us a comment below. And hey, if you want us to look into a specific company next, just let us know in the comments. We do read them. Okay, let's unpack this then. Before we dive into those $45 price targets and all the recent volatility, we need to establish the foundation, right? So what is Ramaco Resources, fundamentally?
Right.
And what makes it different from other coal companies that maybe don't grab the same headlines?
Well, what's interesting here is they're not just, another generic energy miner. Ramaco is a leading producer of metallurgical coal, or people call it met coal, mostly in Central Appalachia. And they serve global steel makers. That's a really critical distinction because met coal demand is intrinsically tied to industrial growth steel production. It's not really power generation, which, as we know, is facing pretty rapid decarbonization. So that gives it a slightly different risk profile, you see.
Okay, but let's be honest. Coal is still coal, isn't it? I mean, in an environment where the whole financial world seems to be pushing ESG, decarbonization,
Yeah.
how does focusing on met coal not represent a huge systemic headwind? Oh, it absolutely is a headwind, no question. But this is where their operational structure really matters. Their core strength, and maybe the reason they can navigate these shifts, lies in their low-cost mining profile and highly efficient logistics compared to many of their peers. If you're going to be in a cyclical commodity business like this, you really need to be among the lowest cost producers. And Ramaco has shown their position pretty well on that industry cost curve. Right. And that low cost profile seems to be translating directly into their margins, which is key for stability. Looking at 2024, the numbers here, they show a robust, pretty healthy business, even if you ignore the whole speculative growth story for a moment.
Precisely. Yeah, for the full year 2024, Ramaco reported total revenue of about $539 million. That marked a very solid 14% year-over-year increase. But the stability, I think, is really in the profitability. 2024 net income hit $81.6 million, giving them a net margin of, 15.1%. And if we look specifically at gross margins, they stood at 22% for 2024. Now, for a cyclical U.S. coal miner, maintaining a 22% gross margin consistently, that's comfortably above peer averages. It suggests they have, either pricing power or, more likely, operating efficiencies that others might lack.
And crucially, it sounds like they're managing that cash flow extremely well. Strong profit doesn't mean much if you've got a bloated balance sheet, right? How does their financial prudence look?
The balance sheet is, it's really the unsung hero here. It's what allows this whole rare earth story to even be plausible. As of the first quarter of 2025, they were sitting on about $75.6 million in cash and short-term investments. Pretty good cushion. But here's the number that really matters for financial flexibility. Their net debt to EBITDA leverage ratio. It sits at approximately 0.4x.
Wait, 0.4 times. Help us understand why that number is so critical, especially in such a volatile industry.
Right. So if we connect this to the bigger picture, a 0.4x leverage ratio means they are, practically bulletproof against typical market swings in their sector. Most heavy industrial companies, they might operate with leverage ratios between maybe 2x and 4x. Ramaco is barely leveraged at all. This low leverage provides them with massive financial flexibility. They don't really need to worry about debt covenants if met coal prices suddenly drop. And they have the capacity to get external financing quickly if needed, or just fund large capital projects internally. It provides a really critical floor sort of beneath the stock price.
Okay, that makes perfect sense. So you've got this solid cash-generating, low-leverage foundation in met coal. But here's where it gets really interesting, as you said. Their long-term strategy isn't just about digging coal. This foundational strength is enabling a massive pivot. We have to talk about this diversification effort into rare earth elements.
Yes, exactly. They're explicitly investing in a completely new future, which is, frankly, where all the market frenzy is coming from lately. The company spent about $18 million on capital expenditures just in Q1 2025 alone. And that money isn't just for, maintaining coal assets. It's primarily focused on developing rare earth processing capacity out in Wyoming. This is the big new growth initiative. The aim is to diversify them away from the cyclical nature of steel inputs and into the higher growth, strategically critical rare earth materials market.
That future-looking, highly ambitious investment. It provides such a stark contrast to the stock's actual performance leading up just the last few weeks, doesn't it? If we look at the sources detailing the technical indicators before that massive surge, the signals were anything but bullish. More like boring.
That's absolutely right. Yeah, if you were looking at the stock in, say, early September 2025, the technical picture was just one of complete indecision, like you said, kind of boring. Momentum was neutral. The relative strength index, the RSI, was sitting right near the midline, around 48. That tells you the stock wasn't really overbought or oversold. It was just waiting for something, treading water.
I remember seeing those moving averages, too. They were practically flatlining, weren't they?
They were basically kissing. The 50-day simple moving average was $10.40, and the 200-day SMA was $10.75. When those long-term and short-term averages are that close together, it just indicates a flat, tight trading range. The stock had been pretty much stuck between support around $9.60 and resistance near $11.20 for months. The market was just holding its breath.
And then, the explosion. How does a stock that's technically signaling maximum quiet suddenly make these kinds of headlines and surge like this? We're looking at a huge move, right? From like $11 to over $30 in just days.
It was purely event-driven. Specifically, it was on the back of analyst enthusiasm, tied almost entirely to that rare earth story we just discussed. On September 19th, 2025, Ramaco Resources stock surged to a really stunning 52-week high of $32.17. And this happened immediately following a dramatically bullish analyst upgrade. Jefferies, the investment firm, they raised their price target from $27 all the way up to an aggressive $45.
$45. Wow, that's nearly 4 times the stock's price just a few weeks prior. That doesn't just signal confidence, that signaled like extreme optimism that this rare earth potential isn't just viable, but commercially transformative.
It is extremely rare. You just don't often see a price target jump that audacious, especially for a company still fundamentally relying on coal revenues. The market reaction clearly shows that investors, or at least some segment of the market, completely bought into the narrative that this pivot transforms Ramaco. From just a cyclical met coal miner into a strategic rare earth developer, that upgrade essentially priced in years of successful rare earth execution almost overnight. It created this massive split, though, in the market because the median analyst target, if you look across the board, remains around $12.
Right, that tension. The $12 median versus the $45 outlier, that feels like the whole ballgame right now, doesn't it? What specific recent corporate actions are fueling this belief, besides just the general spending on CapEx?
Well, there have been several key catalysts that seem to be lending credibility to the plan. Back in August 2025, the company announced a proposed $150 million public offering. Now, that's a substantial capital injection, and it was specifically aimed at funding growth and scaling up those rare earth projects. The fact they could likely raise that kind of money underscores some level of institutional faith in the vision. And perhaps even more important tactically was the announcement on September 16th. They retain Hatch.
Oh, Hatch, yeah, they're a well-respected name in engineering, right?
Exactly. A highly respected engineering and project management firm. They were hired to conduct the pre-feasibility study for the Brook Mine rare earth project. Hiring a credible third-party expert like Hatch shows the initiative is moving from just a concept towards, rigorous execution planning. It lends necessary technical credibility.
And interesting that despite all this aggressive expansion focus, they're still committed to immediate shareholder returns. They haven't cut the dividend or anything.
No, they're maintaining that financial stability link. They declared and paid a third quarter 2025 Class B stock dividend, about $0.19 per share. It demonstrates they believe they can both fund the future and reward current holders using those stable coal cash flows. Balancing act.
Okay, so you've got this solid coal business underpinning things, a massive, maybe speculative growth catalyst in rare earths, and these huge analyst expectations driving the price. For the listener trying to decide what to do now, what are the key scrutiny points? What critical upcoming events should they be watching closely to figure out if that $45 target is even remotely achievable?
Okay, the immediate point of scrutiny, I think, has to be the Q3 2025 earnings release. That's scheduled for November 3rd, 2025. Analysts and shareholders won't just scrutinize management's outlook for met coal, which is still important, but crucially, they'll be demanding clear, high-detail guidance, specifically on the precise deployment of that $150 million raised through the public offering. If that capital plan sounds vague or maybe seems inefficient, confidence could wobble pretty severely, especially at these elevated prices.
Makes sense. And what about tangible progress on the actual rare earth front? When do we get some kind of proof of concept?
The next major tangible milestone is probably the initial production results from that Wyoming rare earth pilot project. That's expected sometime in Q4 2025. That will be the first real moment of truth, you could say. Any signal there, positive or negative, on scalability or processing efficiency, well, it's going to dramatically impact market sentiment, especially considering the current $32-ish valuation. Also, just because the massive recent surge, you have to watch the market mechanics. Things like ETF rebalancing and institutional holdings filings. Those are due around September 30th and October 28th. If large institutions start reporting big new holdings following the surge, it suggests deeper institutional validation. Conversely, if you see funds taking profits after that run-up, it could certainly drive some short-term volatility.
Okay, we've covered the tremendous upside potential, the catalyst driving that excitement. But if we connect this to the bigger picture, we absolutely have to talk about the risks, the things that are holding back, perhaps, a unanimous strong buy rating across the board. What risk factors balance out all this excitement?
Well, the most immediate risk is just the cyclical reality of their core business.
Right.
Pricing volatility. Ramaco is still highly dependent on global metallurgical coal prices. Those prices actually softened during Q1 2025, mainly due to swings in global steel demand and trade flows, particularly involving China. So even if the rare earth story works out perfectly, the met coal revenues are going to continue to fluctuate, maybe wildly, and that creates earnings uncertainty year to year.
And then there's the elephant in the room, right? The actual execution risk of the pivot itself. It's exactly. That's number two. Significant rare earth execution risk. This business is fundamentally still unproven for them. It's one thing to find rare earth elements associated with your coal seams. It's a whole different ballgame to build the complex processing facilities required to extract them at commercial scale. And critically, profitably. There's just huge uncertainty around the technical viability and the ultimate economic return on that massive capital investment they're planning. If they fail to execute the ramp-up efficiently, well, that $45 target becomes pretty meaningless pretty quickly. And finally, we can't ignore the standard risk for any Appalachian miner: vulnerability to local regulatory shifts, and the long-term sort of systemic climate and decarbonization policies that perpetually pressure coal demand. Even met coal isn't immune forever.
Okay, so synthesizing all this conflict. Where does the investment consensus actually land right now? You've got the stability of that 0.4x leverage fighting the massive uncertainty of the Wyoming mine, and the $12 median price target fighting that $45 outlier from Jefferies. Yeah, the overall consensus summary is actually still quite cautious, which really reflects the binary nature of this investment right now. It lands at about a 6 out of 10, which translates roughly to a neutral or hold rating. The wider analyst community, the ones focusing more on the current fundamentals, they're keeping that median price target low, around $12. The market is just completely split between analysts who believe the met coal business is still the core story and those like Jefferies who believe the rare earth potential completely changes the valuation multiple.
But the valuation itself is interesting, isn't it? You mentioned the shares currently trade around 7 times 2025 trailing earnings. I mean, that's a massive discount compared to high-growth sectors or anything related to strategic materials usually. Why is the market maintaining that kind of discount if they genuinely believe in a $45 future?
It's a great question. The market justifies that discount, I think, because of two main things. First, the inherent cyclicality and uncertainty of the coal business, which, let's face it, still makes up pretty much 100% of their current realized profit. And second, that massive unproven execution risk hanging over the rare earth expansion. So the low multiple is basically the market saying, okay, we see the potential, but we require a deep discount until that potential actually translates into tangible cash flow and proven results.
Right. So given all this conflict, this tension, what should the listener's investment horizon be if they decide to jump in? Is this a quick trade on volatility, or is it something you hold for years?
The consensus really suggests Ramaco Resources is best suited for long-term investment, if you believe in the transformation story. The short term is going to be incredibly messy, most likely. Challenged by extreme volatility driven by analyst sentiment shifts, news flow, and all the uncertainty leading up to that November earnings call and the pilot results. You'd essentially be betting against market stability for a potentially huge return or a huge loss. The long-term upside hinges almost entirely on the successful ramp-up and the commercial viability of that rare earth expansion. If that fails to materialize, the stock probably reverts to trading more like a solid, low-leverage metallurgical coal miner, which, given the cyclical risks, simply doesn't justify a $32 price tag in most traditional valuation models.
That really does summarize the core tension here, doesn't it? You have this strong, low-leverage balance sheet providing a financial floor. But you have high pricing volatility in the base business, and this massive X factor, this unproven but highly valued rare earth potential driving the recent incredible surge. It's a classic foundation versus maybe fantasy argument playing out in real time. So here's a final provocative thought for you, the listener, to mull over. Given the stock's recent surge to over $32, which factor is truly more important to the current valuation? Is it the reliable, low-cost coal business that generates consistent cash flow and provides that 0.4x financial stability? Or is it the speculative future value of the rare earth elements that, frankly, haven't delivered any commercial results yet? The consensus remains deeply divided on whether you're buying the present stability or betting heavily on the promised future.
That's the critical question for anyone looking at this company today.
Absolutely. Thank you for joining us for this analysis. We'll see you next time on Investing Talk Podcast.